Hello there. Since October, gold has already gained over 12%. And after a short break, perhaps lasting for a few days, another poke higher is very likely. Welcome to myfinancesteacher.org, where our data-driven approach guides every step of our journey towards maximizing profits. Next, let's have a look at some details on gold, and I would also like to have a look at some details of, so to speak, digital gold, Bitcoin. Historically speaking, gold has been following these intermediate cycles, which usually last for around a half a year. Of course, from cycle to cycle, the actual duration either shrinks or stretches, with the average staying around a half a year over the last few years. And within those longer-term intermediate cycles, there are these shorter-term daily cycles, which usually last for around a month and a half or so. Now, zooming in, we are now in an intermediate cycle that started in early October. Zooming in even further, we're now in a second daily cycle, which has been going on for 23 days. And as these daily cycles usually last for anywhere between 1.5 to 2 months, sometimes shorter, sometimes longer, it looks like the daily cycle has already topped and is declining down into its cycle low. Perhaps it's going to decline into the next week. Perhaps the FOMC meeting that's coming up next week might be a bit of an excuse for the traders to jump back into precious metals. So while on the 4th of December gold has poked to new all-time high above $2,100 and has declined significantly since then, I do expect gold to poke one more time higher. Whether we're going to see a new all-time high or not remains to be seen, but from the perspective of the intermediate cycle, it's still very young at only 61 days long. Usually those last for around a half a year. So you would usually expect close to half of that time going up, perhaps for 2 to 3 to 4 months going higher. So after a bit of a cool down into the end of the ongoing short-term daily cycle, I would expect a rally into a third daily cycle of the ongoing intermediate cycle. And again, whether we're going to see a new all-time high or not, that remains to be seen. What's important to emphasize right now, though, is that perhaps with this green bar today, people are jumping back into precious metals slightly too early with some FOMO. After all, gold price has generally been rallying over the last couple of months. People are fearful to miss the rest of the rally. So instead of looking at this historical data with the daily cycles lasting for, let's say, around a month and a half, many traders are following their emotions, in this case the FOMO, the fear of missing out, and jumping in perhaps a little bit too early. Let's see into the next week, especially into the FOMC, to see if gold softens up a little bit further. But of course, nobody knows the future, and gold might just rally up to new all-time highs from here, but looking at the historical data, it's not very likely, with the daily cycle in that case lasting for only 22 days. And talking about emotional trading, to avoid that, it's quite important to look at market sentiment. Here's one measure of a market sentiment, the optimism index on gold. And yes, a few days ago, we came pretty close to this danger zone. Anything above 70 is perhaps getting somewhat overheated. Anything above 80 is quite hot. And a few days ago, this optimism index came as high as 66, pretty close to that 70 level that you want to watch out for. Since then, we are in a bit of a cool down. We're below 60 right now. And again, as the intermediate cycle is still relatively young, it's about 2 months old, I do think there'll be another poke higher, perhaps bringing this optimism closer to 70 before the intermediate cycle tops. Talking about this intermediate cycle top, a likely scenario is given by this seasonality view, which does agree with our expectation for precious metals over the next several months. Looking at seasonality since 2015, the end of that previous bear market in commodities, we see that usually in late November to mid-December, gold is relatively soft, and after that it does rally, as I many times mentioned in many of my older precious metals videos. Gold usually rallies into that Chinese New Year, January, February. And looking at this bottom right, we see that both December and January are usually pretty good for gold. So again, in the intermediate term, we perhaps have another poke towards that 2100, From the very short term, you perhaps want to wait into the next few days to see how gold price develops. On the RSI, we see that RSI recently declined to around 56.4. In the previous daily cycle decline, it dropped slightly below the neutral at 50. So perhaps next re-entry, maybe next week, could be when the RSI again touches that neutral level. So that's the intermediate as well as short-term view on gold. Next, very importantly, I want to have a look at longer-term view. And one important indicator from the perspective of that longer-term view is the Shanghai premium. How much more expensive is gold back in Shanghai versus the Western markets? And back in September, October, we saw this premium spike to historically high levels. And again, looking at historical data, every time this premium spikes, every time it rallies above around 1.5%, we see a significant rally in gold over the next few months. We see this in early 2017 with a premium over 3%, with a premium slightly over 1.5% in 2019. Gold again rallied for several months deep into the second half of the year. Same again in early 2022, with the premium spiking slightly over 1.5%, gold rallied significantly for a repeated touch of the previous all-time high. Same again in late 2022, with the premium above 2.5%, a significant rally in gold into the previous intermediate cycle. And again, we saw a historically high premium back in September, October. It's quite a while ago, but this is not the first time I'm talking about this premium. I've actually discussed these premiums with the members at myfinancesteacher.org at the very beginning of November. So for the most timely updates, make sure to join us at myfinancesteacher.org. Now looking at the same data, the Shanghai premiums, but in an expanded view, going all the way back to the previous significant high in gold, all the way back in 2011, we see another example in the middle of 2013. Even in the midst of this very grueling bear market in precious metals, as premiums spike significantly, gold does manage to rally for at least a couple of months, again, even during that grueling bear market. So these premiums is something you want to keep an eye on, and that's exactly what we do with our data-driven approach at myfinancesteacher.org. Next, as I mentioned, having a quick look at, as they say, digital gold, that's Bitcoin. It does usually follow these cycles lasting for around a couple of months. Of course, sometimes these cycles do stretch. I have seen a cycle lasting for over 90 days. And as gold is approaching $44,000 right now, I think it is getting somewhat overheated, and I might actually reduce my allocation by perhaps around 15-20%. And it's not the first time I'm reducing my positions. I had a bit of a reduction again back around mid-November, and although that was at a noticeably lower price, I am still holding a significant chunk of those positions. By now though, the cycle is already 86 days long. RSI is repeatedly poking into that overbought area, and we do see a bit of a negative divergence on RSI. That is a lower high versus a higher high in price. Usually a negative divergence is a sign of a potential cool down. And again, while nobody knows the future, for what I know, Bitcoin might actually continue straight up into that mid-January, into the announcement about the ETFs. But with how overbought it is at the moment, there might be a bit of a cool down, so reducing the position slightly isn't a particularly terrible idea, but the decline might not actually be that significant, again with the expectations of those ETF announcements. Look at this Bitcoin optimism index. It's poked repeatedly above this red line at around 80, which is usually a warning sign, while the first poke towards that red line is usually at the beginning of the rally into a new cycle. A repeated poke towards the red line, as in say April, is a sign of an impending top. Again, we saw that in April as well as in mid-February. We see a repeated poke above the red line at the moment, and this green line, which is the 10-day moving average of this optimism index, is likely to make a lower high which again, looking at it historically, is a bit of a negative divergence. We saw the same between March and April with a lower high on this 10-day moving average of the optimism index, signaling a bit of a top forming on that Bitcoin cycle. Looking at seasonality though on Bitcoin since 2013, it doesn't really agree much with a bit of a correction. It suggests that Bitcoin instead is going to continue higher into that early January, into that FOMC announcement. After that, January is usually a red month for Bitcoin. So what's very likely to happen is a bit of a buy the rumor, sell the news. Again, while seasonality doesn't agree with a bit of a decline, I think one might take place due to how overheated Bitcoin is at the moment. But after the following rally into that ETF announcements, if there is any slight hiccup with those ETFs, that could be the top of that next cycle, bringing Bitcoin significantly lower. That is all for now. Remember to follow data rather than emotions. And to get help on the data, join us at myfinancesteacher.org. Simply scroll a little bit lower and click this Join Now. The price is going to increase in January, by the way. Have a wonderful Wednesday. Bye-bye.